Corporate Life Cycle Seminar with Professor Aswath Damodaran. I'm Julian Brescia, President of UCEMA Finance Club, and on behalf of the UCEMA Finance Club and UCEMA Finance Department, I would like to say that we are thrilled to have Professor Damodaran joining us today. I will make a short introduction. Professor Damodaran is the author of several widely used academic texts on valuation, corporate finance, and investment management. He is the professor of finance at the Stern School of Business at New York University, where he teaches corporate finance and equity valuation. Professor Damodaran received a BA in accounting from Madras University and a postgraduate diploma in management from the Indian Institute of Management. He earned an MBA and a PhD, both in finance, from the University of California, Los Angeles. Please, if you have any question during the seminar, write them in the Zoom chat, and we will see if by the end of the seminar, Professor can answer some of them. Well, with nothing more to say, I will leave the floor to Professor. Thank you very much.
Thank you, Julian. Welcome, and I can see there are about 125 people. We could have even done this as a Zoom meeting, in which case I could have seen and interacted with you. But at this point, I'll open up for Q&A at the end in case you have questions. Now, I teach 3 different classes. I teach a corporate finance class to my first-year MBAs, which is really about how to run a business. I teach a valuation class, which is really about how to value the same business. And I teach an investment philosophies class, which is about how to approach investing. And in all of these classes, I look for structures that will help me understand what companies are doing and how to think about big decisions we face as businesses and as investors. And today I'm going to focus on one of my favorite structures. It's a notion of a life cycle. And as I describe this, you're going to see that it's actually something that we're all familiar with, because as human beings, we go through this life cycle. Businesses, like human beings, are born, they grow up, they get old, and they die. I know it sounds morbid, but companies go through a life cycle. So let me describe what's in store for each stage of the life cycle. A startup is like a baby, needs constant care and attention. A very young company is like a toddler, falls, gets up, sometimes falls and cannot get up. Then companies enter, if they survive through those years, become companies that are growth companies, young companies, teenage companies, so to speak. Then you hit the peak of your life. This is when everything you touch turns to gold. The management is viewed as amazing, the company does well. Enjoy it while it lasts, because it will not last for a long time. Because after those glory days comes middle age, and then you get old age, and then you go into decline, and eventually there's corporate death. That's the process by which a company moves through the life cycle. And as I said, I find this structure incredibly useful in thinking about corporate finance, about valuation and investing. So let's start the process and think about what it is about each stage of the life cycle that sets companies apart. Let's take the very, very earliest part of the life cycle. You're a startup. You're not making money. In fact, you're losing money. Your reinvestment needs are huge because everything is about the future. You've got to put money back. Usually can't afford to borrow money. So if you do borrow money, it's because you're desperate. And if you're looking at cash flows, they're negative cash flows. You're money-losing companies. You reinvest a lot of money. So that's the nature of a startup. As companies go from startup to young growth, they might start to make some money, but it's more in revenues. They're still reporting losses. They're still reinvesting huge amounts. They still can't afford to borrow money, and the cash flows are still negative. You keep going up the life cycle. You become a growth company. Now you're starting to make money. You're showing profits. But when you first start to show profits, your cash flows are still negative because you're reinvesting large amounts and you still can't afford to borrow money. Then you approach maturity as a company. Now you're starting to make more money. Your growth starts to scale down. That's bad news. But the good news is when you have less growth, you don't have to reinvest as much money. This is when you start to see cash flows become positive, when you can afford to pay dividends, when you can afford to return cash to equity investors, when you can afford to borrow money. And then you go into decline, everything starts reverse. Your revenues start shrinking, your margins come under pressure. You're looking for ways to become smaller as a company. So keep that structure in mind because it is the structure I'm going to use to talk about differences across companies. Now, if you think about what sets up that life cycle, clearly it's not the same for every company. Companies don't age in chronological time. And here's what I mean by that. There are some 30-year-old companies that look really old and some 100-year-old companies that look relatively young. You're saying, how can that be? Let's look at the forces that cause the life cycle to vary across companies. You enter business. Think of how easy or difficult it is for you to grow in that business. One thing you're going to look at is how easy is it to enter a business? There's some businesses where entry is difficult. Regulators, restrictions preventing from entering the business. For the longest time, banking was a closed business. To enter the business, you had to get okays from regulators. It was very difficult to break in. The second factor that determines how quickly you can grow is how much access you have to capital. There's a reason US companies can grow faster than Brazilian companies because there's more access to capital. There's a reason that European companies often move to Silicon Valley because there's more venture capital access. The third is, what kind of investment needs do you have to bring to the game to get started? Manufacturing companies take a lot longer to build up than software companies. Why? Because you have to build capacity, you have to build factories, and there's a time lag between when you start building and when product actually comes out. So how quickly you can enter a market can vary for different companies. Now, some of you might say, I'd like to be in a business where I can grow faster. You're right. That's for the last 15 or 20 years, that's been the focus in Silicon Valley. Building business models that can scale up. And I'll give you an example. For the longest time, entering the hotel business took a lot of time. Why? Because you had to go buy real estate, you had to build hotels. It was a big infrastructure business. It took you 30 or 40 years to become a large hotel company, maybe even longer. Silicon Valley did not want to wait. So if you look at the biggest innovation in the hospitality business, it was what Airbnb did. What did Airbnb do? It allowed you to do what hotels do without the upfront investment. For those of you not familiar with Airbnb, of course, it doesn't own the apartments, it doesn't own the places you rent, so it costs them almost nothing to enter a new market. It's easy to enter, it's easy to grow. You can do it with relatively little capital. What took Marriott and Hilton 80 years to do, Airbnb did in 5 years. This is amazing, right? Same thing with car service. Until Uber came along, building a car service business took a lot of time. Think of how much quicker Uber did it. And for a decade, that's what Silicon Valley has priced. It wants companies that can scale up quickly. But business is all about trade-offs. Those companies that can scale up quickly, that have these easy businesses to enter, there's a catch, which is once you get to the top, you don't stay at the top very long. The old-time manufacturing companies might have taken 60 or 70 years to build up, but once they got to the top, they stayed on for an extended period. Why? Because new companies had to work to enter the business. For a century, the last century, there were no new automobile companies in the US. There were 3 automobile companies, GM, Chrysler, and Ford. And for a century, every young startup automobile company crashed and burned. DeLorean, classic example. Company that claimed to have a lot of promise, couldn't make it past year 10. So the advantage of slow building businesses is you can last at the top for a long time. And when you start to shrink, it takes a long time for it to happen. I'll give you an example of a quintessential 20th century company. The great companies of the 20th century had these long life cycles. The company I'm sure you've all heard of, which is GE. GE, of course, was created by Thomas Alva Edison in the 1870s when he was experimenting with phones and electricity. He founded GE as his electric company. It went public in 1892. Think about that, 1892. It took GE almost 60 to 70 years to build up to become a big company. It stayed at the top for another 50 years. Eventually, its age caught up with it. Starting in 2008, 2009, it started aging. And now, of course, GE is a walking dead company. It's basically reached the end of its life. But before you shed any tears for GE, it's had a long and glorious life, 125 years from start to finish. That was the quintessential 20th century company. However, the 21st century, if you look at the 10 biggest companies on top of the market cap table in the US, you know, the biggest company and the top of the list is, right? It's Apple, followed by Microsoft. I mean, mostly tech companies. You're saying, so what? I describe tech companies as aging in dog years. I don't know whether you have the same conventional wisdom in Brazil, but dogs supposedly age 7 times faster than human beings. Tech companies age much more quickly than traditional companies. Why? Because they can grow faster. I'll take the quintessential 21st century company, even though it was founded in the 20th century, a company called Yahoo. Founded in 1992, but by 1999, Yahoo was a $100 billion company. It went from 0 to 100 billion in 7 years. What took Ford almost 75 years to do, Yahoo did in 7 years. That's the good news. Here's the bad news. Yahoo's stay at the top lasted exactly 4 to 5 years. In fact, we can date the day Yahoo started to die. It was the day that Google went public in 2004. And then it was all downhill for Yahoo. By the time you got to 2012, Yahoo was a dying company. And by 2015, it was done. 1992 through 2015. The typical 21st century company is more like Yahoo than GE. The reason I bring this up is almost everything you're taught in business school, almost everything you're taught in valuation and corporate finance and investing and marketing is designed for the 20th century company. Almost every case study you read is about a 20th century company. But the 21st century company looks very different. I think we need to rethink how we teach business, how we do business, how we value companies, how we invest in companies, given the fact that the companies we're investing in are no longer those 20th century companies. The tech life cycle has compressed. It's a much shorter life cycle. And as a consequence, everything we do in business has to adapt to it. So with that long lead in, let's talk about how to classify companies based on life cycle. So you say, if I gave you a company, how would I know where to put in the life cycle? I would start by looking at 2 things. One is, what kind of revenue growth do you have as a company? Revenue growth is a much better measure for growth in a company than earnings growth or operating income growth, revenue growth. Young companies tend to have high revenue growth. Older companies will have lower revenue growth. The second metric to look at is operating margins. I don't want to generalize too much, but young companies will tend to have low or negative operating margins. As companies age, their margins should improve. So I'll back this up. I took every publicly traded company in the world and I broke companies down based on corporate age. So basically, I took every company. So there are 47,000 companies in my sample. I computed the age of every company. So as an example, Coca-Cola is 97 years old. Microsoft is closer to 38 years old. Apple is about 40 years old. And then I broke them down by decile from youngest, so that's the bottom decile, to oldest companies. Take a look. The youngest companies have much higher revenue growth than the oldest companies. To be expected, but it's good to see the pattern. Youngest companies grow at about 18%. The oldest companies grow at about 1.6%. In terms of operating margin, the youngest companies tend to be money losers. The oldest companies tend to be more profitable. So one thing you can look at is revenue growth and margins. I was interested to see what the breakdown of companies was around the world. I wanted to see where in the world are the youngest companies and where in the world are the oldest companies. So let's take Latin America. The median age for a company in Latin America is about 37 years. That's actually higher than the median age in the US. The median Latin American company is older than the median US company. These are publicly traded companies. So maybe there's a selection bias that it's more difficult for companies to go public in Latin America, and you therefore get a large number of older companies. The part of the world we have the oldest companies is Japan, 54 years old. So I'm not suggesting this is a perfect proxy, but one thing you can look at is just corporate age as a measure. Now, there's also people use shortcuts, right? If you talk to them, where are the young companies? Tech companies are young. That used to be the easy catch-all, right? Because in the 1980s, every tech company was in fact a young company. That's starting to shift. As you look across sectors, it is true that technology companies tend to have higher revenue growth than other sectors, but actually the highest growth sector globally, if you look at sectors, is healthcare. Tech companies are no longer the youngest companies in the market. Using tech as a shortcut for young and growth is no longer working because technology now is maturing as a business. So whatever your proxy is, start to think about it, because that's the first step, is classifying companies based on where they fall in the life cycle. Just before I got on, I pulled up the top 10 Brazilian companies in terms of market cap. I have to pull up the top 10 Latin American companies. But as I look at the list of the biggest Latin American companies, what I see are old companies and financial service companies. I see very few young companies making that list. I'm not saying this is good or bad. It is what it is. So that lead in, let's talk a little bit about how companies vary across the life cycle. Let's start by looking at accounting. You've all taken an accounting class, I'm sure, at some point in time. But we know how accountants break down the world. They look backwards and they break down assets into fixed assets and current assets and financial assets. And then on the liability side, they have short-term debt, long-term debt, current liabilities, and shareholders' equity. I would encourage you to set the accounting balance sheet to the side and replace it with what I call a financial balance sheet. Saying, what's a financial balance sheet? In a financial balance sheet, I break assets down into investments you've already made, assets in place, and investments I expect you to make in the future, growth assets. I'm giving you credit for things you haven't even done yet. And on the other side of the balance sheet, there are only two ways you can fund a business. You can borrow the money, debt, or use your own money equity. The reason I want you to think about companies in terms of investments you've already made and growth assets is it gives you a great way of thinking about how companies evolve as they move through the life cycle. When you're a mature company, the bulk of your value comes from investments you've already made. When you're a growth company, the bulk of your value comes from growth assets. You're saying, so what? Accounting balance sheets are designed to capture assets in place, investments you've already made as a company. So I'll give you an example. You've heard of Kraft Heinz, right? Kraft Heinz, it makes ketchup. It's a mature company. So I looked at its accounting balance sheet, and I want you to focus on one number. See this value for equity, 49.4 billion? That's what the accountant is telling me the equity is worth at Kraft Heinz. It's a book value of equity. I then took their actual market cap, and it turns out that at least for Kraft Heinz, the market value of equity is very, very, very close to the book value equity. It's almost identical. Saying this is good. Why do I have to do valuation? I look at the book equity for a company, and for Kraft Heinz, that would have worked. But before you get too excited, let me give you a second example. We're on a platform right now, Zoom, which took off during COVID. It was a young growth company that found even more growth. This is what the accountants claimed Zoom's equity was worth in 2021, $5.3 billion. I'm sorry, $3.9 billion. That's what the accountant claims the equity is worth. You know what the market gave it as a value? $30.5 billion. Does it mean the market's gone crazy? No, it just means that in Zoom, the bulk of the value comes from things people expect Zoom to do in the future. So the bottom line is when you look at companies, you look at financial statements, remember, financial statements become less and less meaningful for young companies. When I value an IPO, when I value a young company, there's not much I'm going to learn by looking at accounting statements. There's not much information there. I was just valuing NVIDIA. NVIDIA, as some of you know, has been one of the great success stories of 2023. You know what's driving its value, the market cap up, right? It's AI and how NVIDIA is making chips for AI. It's going to benefit from it. I looked at NVIDIA's financial statements, and there's something I can learn. It's a great company. I can see its growth, but much of the value that I'm giving NVIDIA comes from the growth in the AI business, which is not in its financial statements now. And if you're doing balance sheet-based valuation, which is what accountants often do, it's not going to work with young companies, because with the young companies, the bulk of the value comes from future growth. I know accountants talk about fair value accounting, which to me is an oxymoron, because you can either do accounting or you can do valuation. You can't do both. I'll make a prediction. Fair value accounting will not work in capturing the value of young companies because it's incapable of capturing that value. So that's the first lesson. Accounting becomes less and less useful for young companies because you can't look at the past and just extrapolate. So let's move on to corporate finance. As I said, this is the first class I teach to my MBA. So many of them have never taken a finance class before. And I take them through the three core principles that govern how you run a business. Three principles are the investment principle, the financing principle, the dividend principle. Now, before you get too intimidated, let's cut to the chase. The investment principle, all it says is when you as a business go out and make investments, you want to invest in assets, projects, acquisitions that earn a return that is greater than some minimum acceptable hurdle rate. You're saying, what the heck is a hurdle rate? I'm not quite ready to delve into the details, but the hurdle rate should be higher for riskier businesses and lower for safe businesses. The return should reflect cash flows, not earnings, should reflect when you get those cash flows and have all side effects built in. That's the investment principle. The financing principle says find a mix of debt and equity that minimizes your hurdle rate. You want a lower hurdle rate rather than a higher one. And try to find debt that matches up to your assets. And the dividend principle says if you cannot find investments that make your hurdle rate, give the money back to the shareholders. Dividends, buybacks, it doesn't matter. That is corporate finance on one page. Now let's look at how corporate finance shifts as you move through the life cycle. Remember the three core principles, right? The investment principle, the financing principle, the dividend principle. When you're a young company, it's investing all the time. Don't even look at financing or dividend. Financing, there's no point. You can't afford to borrow money. Dividends, you can't afford to return any cash. It's all about finding good investments. So for young companies, you're going to see a dominance of the investment principle. As companies mature, you're going to see the financing principle come to the forefront. And when companies go into decline, you're going to see the dividend principle win out. So even though there are three principles, where you spend your time will vary across the life cycle. So when I think of investing across the life cycle, youngest companies face the biggest challenges in investing. Why? Because they have no history, they've never done this before, but it is actually the driver of the value. The where you direct your money and what you invest in will make or break your company. As companies mature, your biggest challenges shift as well because you now have an established business. You're trying to make sure you're capturing disruptors and competition when you do your investments. And finally, as you become a declining company, you're really not taking investments, you're shrinking. Your big investments are, how much do I shrink? What do I sell? The nature of investing changes as you go through the life cycle, and the importance of investing becomes less critical. I've already told you about financing. Young companies can't afford to borrow money. So when a young company asks me, how much should I borrow? My reaction is don't. They say, I have no choice, then realize you're doing it because of desperation. A young company should not borrow because it doesn't have the money to service the debt. As companies mature, your capacity to borrow money will go up. And when you go into decline, you got to make sure that you're retiring debt as you shrink your company. So again, financing shifts over time. And finally, on dividends, early in the life cycle, you're not returning any cash. When you're first able to return cash, it's better to do it in buybacks than dividends. Why? Because you have more flexibility. And as you get more established as a company, maybe you want to start paying dividends. I could teach an entire corporate finance class built around the corporate life cycle. You tell me where you are in the life cycle. I'll tell you what kind of investing, financing, and dividend policy I would expect to see. Now, one of the things you will notice is early in a company's life, you will have negative cash flows. That's called cash burn by venture capitalists. They often wring their fingers and say, this is terrible. My company's burning through cash. Cash burn is a feature, not a bug. Young companies will be burning through cash. It's the nature of the process. It's as growth starts to ease up and gets lower that cash flows will turn from negative to positive. And once they become mature companies, you can return more cash. I don't do any consulting, but if I were asked by a company to come in and give them advice, my advice is singular. Just act your age as a company. You're Vale, stop talking to me about growth. You're a mature company, behave like a mature company. If you're a young company, behave like a young company. More value is destroyed by companies trying to act younger than they are. And you know who aids and abets them in this? Consultants, bankers tell them, you can be young again, just do a big acquisition. And my advice is push back. Act your age. It's the most sensible thing to do. Let's talk about valuation. The other class I teach, and I'm big on telling people, look, don't make valuation into an Excel spreadsheet. I describe valuation as a bridge between stories and numbers. You might say, what does that even mean? In every good valuation, every number you have in your valuation has to have a story that goes with it. And every story you tell me about a company has to have a number that goes with it. Good valuations are bridges between stories and numbers. So if you take that to the next step and say, well, where does this play out? If I gave you a very young company to value, remember there are no numbers, there's no history, no financials, it's all story all the time. As companies age and they get more numbers, you can build your valuation of the numbers, but there's still a story embedded in the numbers. So pick your favorite company, think about the story that goes with the company, think about the numbers, think about the balance. If all you do is value mature companies, you can get away being an Excel ninja, opening up Excel spreadsheets, entering numbers, projecting things out. But if you value young companies, you have to have the capacity to think, well, what's the story for the company and how does it play out in the value? Here's the other thing. Now, not only a young company value driven by stories, those stories will diverge across people. 10 people looking at a young company can come up with 10 very different stories, which means there's going to be far more disagreement about value at young companies than at more mature companies. Welcome to the club. I value Tesla every year now for a decade. Every time I value Tesla, it's amazing how much people disagree with me. It doesn't surprise me in the least. It doesn't bother me in the least. Young companies, you're going to get much more disagreement about value. So if you think about what does that even mean? With young companies, my advice is start with the story. Recognize that this is your story. You don't have the story, you have your story. That other people will disagree with you. And the story itself will change over time. I mean, I've owned NVIDIA now for 6 years. And I had to revalue NVIDIA. I did it today. And as I was valuing it, I recognized how much my story for NVIDIA has shifted just over the last year. I don't apologize for changing stories. The world changes around you. Your story should change to reflect that. When your story changes, your value will change as well. So I'll take you back to June of 2014, when I valued Uber. At that time, a young money-losing company with no business model. I told a story about Uber. I described it as an urban car service business, which will bring new users into the business with local networking benefits. You might say, what the heck are those? Essentially, once you become the largest ride-sharing company in a city, there's going to be a tipping point where you become the dominant one. And in 2014, I assumed they could keep doing what they were doing, which is not own the cars, not hire the drivers. That was my original story. That story was what I converted into a valuation by taking each part of the story and making it a number. My urban car service part of my story allowed me to use the urban car service market as my total market. The fact that they could attract new users allowed me to use a higher growth rate for that business. The fact that they had local networking benefits allowed me to give them a 10% market share. every number in this valuation is tied to my story. So any number you point to, and eventually it looks like an Excel spreadsheet, but every number in this spreadsheet is driven by the story I'm telling about Uber as a company. Get comfortable telling stories about companies, because if you don't, you cannot value young companies. Now, as I said, stories can diverge. Different people looking at the same company can come up with very different stories for the same company. But 4 years ago, when I valued Tesla, I laid out the different stories you could tell. I said, let me give you the choices. What business is Tesla in? Is it a car company? Is it a tech company? Is it a clean energy company? It's focused on just the high end. Is it mass market? What kind of competitive edge do you think it has? The fact that it was first, that it has great styling, or is it technology? Now, because on each of these, I'll wager you'll get disagreement among people. And what you choose as the business, the focus, the competitive edge, the intensity will play out in your revenue growth, your margins, your reinvestment. So for those of you who track my blog, I did value Tesla earlier this year at $130 per share. The stock is now trading at $250. I'm getting a lot of pushback saying, are you sorry now? I said, no, I had to give a story. I had to feel that was my story. I had to make my investment decisions based on that story. So with young companies, stories will diverge. Just to give you a sense of by how much, I actually took Tesla and showed how much the value would diverge depending on what story you tell. Big auto tech, auto FANG. FANG, of course, is Face, Amazon. So you think of it as a big tech company. The kinds of revenue growth, margins, and reinvestment assumptions you make are different. You can end up with values that are wildly different depending on the story you tell for the company. As companies age, though, the stories will get more bounded. You don't have as much room to run. When I told you the biggest Latin American companies are big, mature companies, there's going to be far less disagreement when you value a Petrobras or a Vale than when you value a Tesla. There's not that much room to run. What are you going to tell as your story? Petrobras is not going to become an AI company. Vale is not going to become a semiconductor company. So when your companies mature, your story will get more bounded. For instance, this is the valuation of Unilever. Unilever, as many of you probably know, is a multinational consumer product company. It makes soaps, it makes houseware products. It's been around forever. It's been around more than a century. It's a mature company. Where does it show up? If you look at my revenue growth rate for Unilever, it's 2% a year. I'm telling you a story of low growth with margins that are pretty stable. Would I like to tell a more uplifting story? I would, but I can't. In the case of Unilever, would not fit. I'll wager there are many Latin American companies where the only story you can tell is a story of constrained growth because they're mature companies and margins staying pretty stable, even in your best case. That's what's going to play out, and you're going to see it play out in the valuation. But I'll wager if you took 100 people and asked them to value Unilever, the difference in values will be far, far smaller than the differences in values you'd get if you gave those same 100 people Tesla to value. And when companies go into decline, valuations can become depressing. As many of you know, brick and mortar retail in the US is now a dying business. Amazon killed it. So if you're a traditional mall store or you have a physical store, it's tough for you to survive. So a few months ago, I valued this company called Bed Bath & Beyond. It's a company that had its glory days about 20 years ago, grew fast, but now it's difficult to find somebody who wants to go to a Bed Bath & Beyond. It's a dying company. You know how this plays out? If you look at my projected growth, it's negative. I expect the company to shrink over time and shut stores because it is a declining company. The margins might improve as they shut down their worst stores, but not to some high number. This is a depressing story, but it's the best story I can tell for Bed Bath & Beyond. So here's my advice for you. Pick 5 companies you're interested in. Pick companies don't pick companies just for the sake of picking companies. Pick 5 companies, very different companies, maybe in different markets, and then ask yourself, what is the story I would tell about that company? If you get a chance, you can visit. If you visit my blog, I looked at US banks a couple of months ago because I wanted to see what the story was that was driving US banks. And the banking story is a fascinating one. You can have a story that looks great, and all of a sudden comes apart at the seams. There's stories that teeter on the edge of trust because if people don't trust you anymore as a bank, you're done. Deposits get withdrawn, you go into a meltdown. So valuation shifts as you move through the life cycle from being focused primarily on numbers to primarily on story to primarily on numbers as you go from young to mature companies. Which brings me to another aspect of markets that I think is worth thinking about. There are two words that I see people using in markets interchangeably that I don't think they should. The two words that I see them using are price and value. You know what drives value? It's cash flows, growth, and risk. We've known for a long time. You might use a discounted cash flow model to assess value. We also know what drives price. It's demand and supply. If you're ever asked to value something, you got to understand the business, come up with cash flows, growth, and risk, and come up with a value. If you're asked to price something, all you have to do is find other people who are paying prices for similar assets. What are they paying? And decide that's what I'm paying for my asset. Pricing is about looking at what other people pay for similar assets. Value is about cash flows, growth, and risk. You're saying, so what? When you look across the life cycle, early in the life cycle, most people don't even try to value companies because there's too much uncertainty. You say, what about VCs? VCs don't value companies, they price them. Based on what? Number of users, number of subscribers, number of downloads. So with young companies, it's mostly pricing. Value doesn't even play a role in the game because it's driven by mood and momentum, trading. As companies mature, you're going to find more investors entering the game. People are more willing to value companies. There's a reason people like Warren Buffett never invest in young companies. It's because they feel more comfortable dealing with mature companies, and that's where you're going to see investors play the game. So as companies mature and going to decline, you're going to find more investors. With the young companies, you're going to find more traders. And because of that, with young companies, what drives price from day to day is less to do with fundamentals and more to do with mood and momentum. So let's talk a little bit about what it is that allows us to price companies. To price companies, you can't compare price per share across companies. Why? Because price per share is almost arbitrary. You can take any company and make the price half of what it is by splitting its stock. So to prevent comparing price per share, we standardize price. What does that mean? We divide price by something. Price by earnings, price by book value. When you see a multiple, you're seeing a standardized price. So when you want to price something, that's where you start. You start with the standardized price. Second step, you find other companies that you claim are just like yours. You might stay geographically focused. Now, I'm going to look only at Latin American companies. The downside is, if you're trying to value Embraer, Brazilian aerospace company, and you say, I'm going to find other Latin American aerospace companies, you have a problem. The problem is, Embraer is it. That's the only company. So sometimes you might have to go across geographies. Sometimes you might have to expand the sector. And then you got to control for differences. Tell a story about why a company deserves to trade at a much higher or much lower multiple than the other companies. That's pricing in a nutshell. So as you look at uncertainty and how it shifts across the life cycle, you're going to see that early in the life cycle, you face tremendous amounts of uncertainty. Much of the uncertainty is the company level. You don't trust the management. You don't know whether the business model will work. All of those things play out. As companies mature, your uncertainty will become more macro uncertainty about the economy, about the country, about inflation. It's a different kind of uncertainty. It does make people uncomfortable, but it is what it is. But as uncertainty rises, you are going to find people price companies more rather than value. In fact, in Latin America, it's amazing how many people have given up on intrinsic valuation. It doesn't work in Latin America, too much uncertainty. So what do? They price things. They use multiples and comparables because their defense is there's too much uncertainty. Pricing is the way to go. I would encourage you to push back. I think the payoff to doing valuation, understanding businesses, is greater in Latin America than it is in the US. Why? Because most people are not even trying. Give it a shot. Try your best to deal with uncertainty, because I think that much as we like to price things across the life cycle based on different metrics, right? Early in the life cycle, because there are no earnings, you price relative to users or subscribers, and you price relative to revenues, then to operating income, then net income, and to book value. You can see the transitions in pricing across. At every stage, I think you can value companies as well. And there's a payoff to valuing companies because it forces you to think about the business model that drives a company. So we've talked about corporate finance, we talked about valuation, we talked about value versus pricing. Let's talk about investing across the life cycle. When you think about the different ways you can invest or play in the market, here are the choices, right? You can be a value investor. And what do value investors do? Well, the most common thing they do is they fly to Omaha, they go to the Berkshire Hathaway meetings, they talk about buying companies with assets in place. Their objective is to find something priced cheaply and hope that the gap disappears over time. You can trade on information coming out after earnings announcements or acquisitions because you assume the market makes mistakes. There are a few who try arbitrage. What is arbitrage? You find the same asset priced at different numbers in different markets. You buy at the lower price, you sell at the higher price, you lock in the profit. Could be a growth investor, but you think your assessment of growth is better than other investors. You go after companies which are undervalued relative to growth. Maybe you believe in efficient markets, which makes your life easy because you just buy index funds and you move back to living the rest of your life. And there are people who look at charts and technical indicators to pick stocks. Seeing which one is best. And I teach an entire class on these philosophies. And the thing I emphasize is there is no one philosophy that's right for everybody. You got to pick an investment philosophy that's right for you, that fits you. And I can't tell you what that is. I can tell you what works for me, but might not be what works for you. But if you think about how that connects to the life cycle, value investing, you're focusing on assets in place. Remember, I gave you the financial balance sheet. You're focusing on things the company's already done. In growth investing, you're focusing on value future growth. They both are betting on value, but they're betting on different components of value. Peter Lynch, who ran Fidelity Magellan in the 1970s, and who brought growth investing to fore, has more in common with Warren Buffett than you realize when you think they're both trying to find undervalued companies, but they look in different places because they have different sets of skills. Now, of course, there's lazy growth investing. What's lazy growth investing? In lazy growth investing, you bet on trends. So let's take a trend. Right now, what's everybody talking about? AI. Now, we know AI is going to be big. You know how we know? Because it's permeating every aspect of our lives, right? I mean, ChatGPT is everywhere, people. So clearly, this is not something that's going to fade away. Unlike the metaverse and cloud, which were more, I'd never thought those would shift the conversation, because the metaverse is really for people with virtual reality. It's for geeks who wear VR glasses. I wasn't one of those. But clearly, AI is going to shift the conversation. It's going to change the way we work, and it's going to change the way we live. So here's what lazy growth investing will do. It says, AI will be big, so I'm going to buy every AI company. I'm going to buy Microsoft, I'm going to buy NVIDIA, I'm going to buy any company with AI in its name. I'll make a prediction. If you do that, you will regret it. You will not make money because it's too lazy. I'll make two statements that sound contradictory, but I'll back it up. I think AI is going to be big, but I don't believe that means that AI is going to create a lot of value. In fact, I am convinced that AI collectively is going to make companies less profitable rather than more profitable over time. Why? Because if everybody has it, nobody has it. If everybody has AI, nobody has an advantage. So if you think about growth investing, you need to go past the trends and think about, hey, what can I do? At the other end of the extreme, you have rigid value investing. What is rigid value investing? You pick companies based on metrics. Low price to book, I'm going to buy the stock. Again, I'll make a prediction. If you buy every low price earning stock in Latin America, you will not make money because most companies that are cheap deserve to be cheap. So if you want to be a value investor, you need to do your homework. If you need to be a growth investor, you need to do your homework. There is no shortcut. I don't know why people think there is. They hope there is. There isn't. It takes work. It takes understanding. And you'll be wrong a lot of the time, but hopefully you're more right than wrong. And on average, you can walk away with the payoff. Which brings me to the last thing I want to talk about. If you read the Harvard Business Review or you read McKinsey, you could be forgiven for believing there's a prototype for a great CEO. Right? You watch the Steve Jobs movie, right? This is what a CEO should look like. Unfortunately, that is not true. You know what a great CEO is? It depends on where you're in the life cycle. And here's why. When you're a young company, think of what drives your value. It's your story, right? So young companies need CEOs who can tell great stories, who can convince people to invest in that story. They need storytellers. Old companies need a very different set of skill sets, right? They need people who are comfortable defending the company or essentially more logistically inclined, to like supply chains, are more efficiency driven. A few years ago, I actually wrote a piece in my blog on what you need in terms of management qualities at each stage in the life cycle. I've tried to summarize it. Early in the life cycle, you need storytellers, you need visionaries. As you move along, you need people who can build a business. Then you move to people who can defend the business. And finally, when you get into decline, you need somebody who can shrink your business. So the risk of being labeled a sexist, I've essentially listed out the perfect CEO for every stage in the life cycle. If you're a young company, you know who I want as a CEO? Steve, the visionary. The guy who gets up in his black turtleneck, clicks the thing, convinces you that he can do amazing things. As you get to young growth, I want more pragmatic people. Purists will never build businesses because they're so stuck with their vision, they cannot compromise. Then you want somebody who can really build a business, Bob the Builder. Followed by mature growth, an opportunist, somebody who can find new ways of growing, even though they're a large company. In maturity, you want somebody who can defend the business. And finally, when you're a declining company, you want Larry the Liquidator, somebody who can shrink the company and make it smaller. You tell me where you are in the life cycle, I'll tell you the right CEO for your company. So if you put me in a CEO search committee, I'm not just going to go find the best CEO who works somewhere else at a different company. I need to know more about your company to get that CEO. So as you can see, as companies age, the emphasis in top management shifts away from storytelling and vision to building businesses and defending businesses. Nothing good or bad about it. It's just different. Can the same person go from being a visionary to a defender? Maybe. But there are some people who are incapable of making that transition. In the old days, with companies, you can get mismatches. Where in a mismatch, you get a CEO that's not matched up to the company, a visionary in charge of a mature company, a defender in charge of a growth company. Because if you get a mismatch and you don't fix it, they can take the company down with them. And I'm going to close with what I think is an issue that we're going to have to face in this century. Remember I said the 21st century company has a shorter life cycle, 20, 25, 30 years. As opposed to, you're saying, so what? You know who the CEO of Ford was when it was a growth company? A man called Henry Ford, a century ago. Visionary. But remember, visionaries are often eccentrics, right? So when Henry Ford built his first mass market car, guess what color it came in? Black or black? He said cars should always be black. Eccentric, brilliant man. But he built up Ford into the engine, the successful company it was. By the time you get to the late 1930s, Henry Ford was starting to become a liability. He was a bit of a Nazi, which was a bit of a problem. But he was getting old. So by 1945, when he died, it was perfect to have a transition because now his grandson would become CEO and he was a very different person. Do you see where I'm going? The 20th century, time took care of transitions because companies lasted 100 years, 120 years. In contrast, think of a company like BlackBerry. Remember the late 90s? I mean, you were all too young to remember the late 90s. Late 90s, BlackBerries were the smartphone of the day. They were dominating. And they were run by these two Canadians, I forget their names, who were viewed as geniuses because they'd built this company from nothing to this worldwide phenomenon. That was between 92 and 2000. You're saying what happened in 2000? Around 2001 and 2002, Apple started with its smartphone, and all of a sudden, BlackBerry went into decline. 8 years later, there was no company left. Same people built it up into this incredible success, and then they drove it into the ground. They were incapable of adapting. We're going to see more and more of the BlackBerry phenomenon play out. In fact, last year, when Facebook had its troubles, remember after they made this big metaverse announcement and their stock price collapsed, people were asking, is Mark Zuckerberg the right CEO for Facebook? But we've created a problem. When a company is not the right CEO, what do you need to do? You need to get 51% of the shareholders on your side and you get them out, right? You can't do that at Facebook. Because when Facebook went public, we allowed them to have two classes of shares. Mark Zuckerberg owns only 13% of Facebook shares, but he controls 57% of the voting rights. And we've done this on young tech company after another one. And we're going to pay a price in the years to come because many of these companies will need management change, and we've removed our capacity to create that change. So I'm going to close with a statement that I think is true for all of us. Growing old is mandatory, growing up is optional. So you can choose to say, I'm 21, but if you're 75, guess what? No matter what you tell yourself, you are 75, you are old. It's going to catch up with you. And many companies like to believe that they're at the peak of their lives when in fact, they're staggering towards their graves. But keep this life cycle in mind as you look at companies in the news and what they're doing and why they're doing what they're doing. So I'm going to stop there, allow for any questions you might have, and turn it back to you.
Thank you, Professor. That was great. As always, super clear in your communication, and really appreciate that. And I'll keep that quote in mind for later on in my young age. As I grow older, I'll keep that in mind. But taking advantage of the few minutes we have left, we're going to open up to Q&A, specifically to some community questions. And to start off, I have one here. So we generally study the corporate life cycle through the lens of developed countries, but how does that life cycle vary if we start looking at countries in least developed regions like South America, for example?
Why does it matter, right? Petrobras is Petrobras. It's an oil company. What does that have to do with whether it's in Brazil? I mean, Petrobras and Royal Dutch are old oil companies, right? So this has nothing to do with developed or emerging markets. In every market, you're going to have old companies, middle-aged companies, and young companies. The one redeeming feature when you're in a young economy is because the economy itself is growing, it allows even mature businesses to have growth because they can grow with the economy. So it gives them a little more buffer. If you're a mature company in Europe, you're in worse shape than if you're a mature company in Latin America. Because a mature company in Europe, population is shrinking, you're looking at a shrinking pie. So you could argue that maybe in young companies, you get a little more leeway, but not much.
Perfect. And for these, you've given plenty of examples of companies that have gone through their whole life cycle and then cease to exist. But there are many that break through that and strive and grow further. What do you think really differentiates those companies? Is there some sort of secret sauce?
Life cycles can range in age, right? All companies grow old. Are Facebook and Google older companies? Yes. Their revenue growth is single digit. It's inevitable. You can't fight aging. You can delay aging. The essence of great management is you can put that off longer, but eventually every company gets old. So when you say many companies break through it, I'm not sure what you mean by that. All companies age. And so the companies that are successful might be able to put that aging off for longer. but eventually they age as well.
Professor Lapena, do you have a question?
Yeah. Thank you very much, Julian. No, I have no questions. The presentation was so good that I couldn't stop listening. I mean, I stay here for the whole hour. First, I want to thank Professor Damodaran for his valuable time. And I have only one question, because we have been using his books for so much time since the 90s. And in the start of the presentation, it reminded me something that he said about a book that he wrote. The title was The Dark Side of Valuation, How to Value Companies with No Earnings, No Cash Flows, No Nothing. Yes.
Right.
And my question, and just taking in account the fact that he put a point on management and the corporate life cycle, is if he has changed his mind, or he has transformed something about valuations since the books he wrote in those times. I mean, if he has changed something about valuations, taking in account what he's presenting now in this seminar.
No, I mean, I think The Dark Side of Valuation was actually written at the peak of the dot-com boom, precisely because we were seeing young companies that we'd never seen in public markets. Remember, before the 1990s, if you're a young company, you didn't get into public markets, you stayed private. VCs funded you, and it's only when you had a business model that worked that you went public. The 1990s was the first time we saw companies jump that and come to the market before they had a business model. Very little revenues, big losses. It's actually the first time I started thinking about how do you value companies early in the life cycle? Because my very, very first books, I was still valuing mature companies because that's what you ran into. And even when you're talking about growth companies, there were companies with established business models. So the Dark Side of Valuation was saying, look, we still have to value these young companies before they have financials, before they have a business model. So that's actually my first attempt at storytelling and how much that drives the value of a company. And it's a process that obviously has taken on speed over the last 20 years, because more and more we've seen, now you're going to see with AI, a lot of young AI companies jump and come into markets. They don't have revenues, they don't have a business model, but they'll be priced at billions of dollars. And you could ask yourself, are they really worth that? Right? And most people say you can't value it, it's too uncertain. And my response is, yes, you can, and you have to if you're paying that price.
But I understand that you now put a stress on management. I mean, you focus a bit
less
more
on management, more on the story. The story, the management is part of the story. But to me, management can't make or break a company. If you have a product or service that nobody will buy, look at how great management is.
Yes,
right?
Sure.
So when you're a young company, management, when we talk about management, management is there to guide the story from story to business. Okay. So I will look at management to see, are they the kind of management that can do it? But management by itself can't make a company go from no value to high value. But they can take a high value company and destroy it if they don't take care of their story and bring it to market.
Okay. Well, thank you very much. We want to stick to the time, your valuable time. We said 1 hour, we stick to that. We really appreciate the Finance Club, really appreciate as well the time that you devoted to this presentation, this seminar. We are so happy to have you here, and we hope to see you in the future. And really, you may know, but your books are so popular when we teach valuation that there's no need to mention.
The book on corporate life cycle should be out by the end of the year. It's coming from Penguin Random. It's a Penguin Books Random House book, so it should be out globally by the end of the year, and hopefully in other languages by the middle of next year. So
wonderful. We look forward to having it. So thank you very much. And
take care.
Really happy to have you here. Take care, you too. Bye-bye.
Bye-bye.
Thank you, Professor.
Take care.
You.